Hey guys, I want to talk interest rates today. There has been a bit of news come out, and the news is that fixed rates from big banks are decreasing, and that's been true probably for, I don't know, 2 weeks, 4 weeks, something like that. That doesn't mean interest rates are going to come down. What I've slowly been noticing, which is probably going to become a talking point over the next month or two, is that people are taking, in my opinion, assumptions which won't be proven right until they happen. I'm not sure they will happen. To give you a better idea, I'll give you an example. I see property people pumping up the property market, saying because interest rates are dropping, borrowing powers are going to increase, then people are going to be able to borrow more and they're going to buy property, and that's going to pump the market. That's true. Like, borrowing powers will increase if interest rates do drop. Unfortunately, if fixed rates drop, the borrowing powers don't increase. So a lot of these guys are saying interest rate drops are coming. The problem is they're not actually here yet. And sure, I agree, interest rates can come in the future, but whether they come in kind of the next short period of time, 2 or 3 months before Christmas, who actually knows? And my suspicion, the longer we go on for, is that actually we're not going to see interest rate drops. Now, that might seem a bit against the grain because the big banks are already dropping their fixed rates, which probably tells you they think that interest rates are going to come down. The thing is, they haven't come down. And inflation at the last reading, which is the June quarter, June 30, inflation is still 3.8%, which is a lot higher than the target rate, which is 2 to 3% of inflation. So we've got high inflation, definitely a lot lower than before, but the cost of stuff is still going up faster than what we've expected. Now, to pair with that, our wage growth, I think, is 4.1% the last time I checked. So if our wage growth is growing, then it's likely, well, there's a higher chance that it's going to be harder for inflation to come down. You got to pair that with things like the tax reductions that went through on June 30 as well. So people have extra money in their pocket, which is what the government intended to do, to give people some extra money. That's probably going to get spent. So it's going to have some sort of inflationary effect. As to how much, we don't actually know yet. The reason I want to talk about this is because the main way people get financially wiped out through thousands of years of history on debt is they either get wiped out by a natural disaster, or they just can't afford the debt burden and they have to sell all their assets. The fact that we've gone 30 years or whenever the last peak was in the early mid to mid 90s, the fact that we've gone so long has just meant, in my eyes, that a lot of people have a recency bias. But I think you really need to be careful here, because you can look at plenty of times in history, but all you need to do is look between the early 90s, when we had home loan rates of, I can't remember what the figures were. I think 17 or 18%. And then obviously they came down to 1.89%. That all happened over a period of about 30 years. If it's possible for interest rates to come down on average, reducing, obviously they went up and down in that period, but on a trending average to come down over 30 years, then it's possible to go up over an extended period of time. So this assumption that interest rates are just going to come down by a meaningful amount, I'm not going to make that assumption just yet. I'm going to wait and see. The thing is, interest rates would have already come down. Like America, Canada, New Zealand, Britain, all of these other economies have reduced their interest rates so far. So I can understand why people would think Australia is going to reduce their rates. But on the flip side to that, there is a reason we haven't reduced our interest rates yet. And that's because our inflation is still above average. And also our unemployment is still quite low. I think that is part of the reason why the inflation rate is still quite high, because there's still shortage in the jobs market. Not many people are fearing losing their jobs and not being able to replace their job in, a couple of weeks. And that means that people will continue spending. If you want people to stop spending, unemployment rate has to go up, and people have to fear that if they lose their job, they might not get another one. Therefore, they must save and they must stop spending everywhere they possibly can. That's not quite happening at the moment. For me, I'd kind of look at that and say, okay, well, there's probably still a little bit of leeway here, even though it might feel for everyone out there that things are pretty tough. Unfortunately, the problem is that our government has been creating a lot of stimulus, a lot of money spending into the economy, which is doing kind of a reverse effect of what higher interest rates are meant to do. So I actually think we need to be really careful on interest rates. There's a reason our grandparents and some of our parents are basically allergic to debt, and that's because these sorts of times have happened before. I just think we just need to focus on reducing debt. There is an increased chance that interest rates are going to go up over a long period of time. I don't know that, and time's going to tell. I look at my personal finances and I look at planning around worst, hoping for the best, but planning for the worst. If you're out there listening, I would urge you to consider what would happen if interest rates went up another 2%. I'm not saying that's going to happen now, but I'm saying it's definitely a chance of happening. You know, rates went up from 1.89 to 6.29 in 18 months. Most of that was done in actually 15 months. I would ask you to consider this scenario and say, hey, is that really going to hurt? What if it goes to 9 or 10%? Now, again, that might seem like it's a bit pie in the sky, but 6.2 sounded like pie in the sky when everything was 1.89%. So we can't rule out these scenarios. I don't want to scare people. That's not the point of why I do this. The point of why I do this is to help people make it financially, and getting crippled by debt and selling your assets does not work, because we've seen the long-term trend. I'm talking 3 or 4 decades here. Wages are going up slower than assets are. Assets being stocks, house prices. So if you have to sell your assets now, it's going to be harder to buy them back in 10 years' time when your finances get cleaned up. Basically, if you're forced into a position where you cannot afford your debt burden, there is a risk you'll have to sell your property, your home, and then there's a risk, the increased risk, that you won't be able to buy into the housing market again. And I think that's, personally for me, I don't see how that's a good outcome, but no one's kind of looking at these potentially bad outcomes, it seems. That's my message for today. Watch out for interest rates, especially when the narrative is everyone's on one side of the boat saying it's going to stay flat or it's going to come down, and more people are saying it's going to come down. I'll just be aware and say, look, it's not coming down until it's coming down. I'm not counting my chickens until they roost. Cheers.